Hello and welcome to CNBC TV18 special series Asian Tigers from Hong Kong. My guest today doesn't really need an introduction. He was ranked among the top 10 investors of the 20th century, putting me alongside likes of Warren Buffett, Julian Robertson and George Soros. But Bill Gross was for bonds. He was considered the same for emerging markets. Yes, joining me now is the guru of emerging market equities, Dr. Mark Mobius. Dr. Mobius, thank you very much for joining us on the show.
Thank you for the nice introduction.
Thank you. Talking about emerging markets first, it's been a rocky start, but you believe that the emerging markets are at a turning point. Why do you think so?
Yeah, because we've had 3 years of underperformance for emerging markets. If you look at performance of the index, emerging markets index, you'll see it's underperformed the U.S. market, it's underperformed the world market for 3 years. And of course, that has resulted in a net outflow of funds from emerging markets, dedicated funds. So now we're beginning to see a turning point where money is coming back in to the emerging markets arena. And that includes not only equities but also fixed income.
Okay.
So that's one sign of a turning point. The other sign is the weakening of the US dollar.
Okay.
If you notice, emerging market currencies, of course, had an incredible nosedive. They came down tremendously. Now they're recovering. And against the US dollar, they're looking better and better. So, and finally, most importantly, sentiment regarding interest rates in America, the Fed. What is the Fed going to do? What are their intentions? Now the sentiment is more towards perhaps no more increases in interest rates in America. So this all put together leads people to believe that maybe they should look at emerging markets. The other factor, which is very, very important, is that most of the international investors are severely underweight in emerging markets. And they've been underweight for about the 3 years that I just mentioned. Now, when there's a turning point, as you know, with a lot of people underweight, that means a lot of people are shorting the market. And when there's a turning point, the shorts have to cover, and then you have a very rapid rise.
Sure. So what we saw in the last, say, 4 weeks or 5 weeks, a bit of rebound in EM indexes, a rebound in Indian markets as well. Was it to your mind more of a short covering rally, or you think there was general money as well put to work?
Well, I think you're going to get an element of both. You're going to get some people saying, look, I'm underweight, and therefore I'm going to be in emerging markets for the next year, 2 or 3 years. Then there are the short-term players who say, well, look, it's gone a little bit too far. I'm going to get out now and take my profits and wait for a correction. So whenever you see these kinds of recoveries, you'll see, a spurt and then a correction, another spurt, another correction. But you see higher highs and higher lows as you're going up.
Okay. A lot of people believe that right now EMs are in a sweet spot because the Fed tone was dovish. The China data seems to be stabilizing a bit. Can this continue, or you think the Fed is eventually going to hike rates, and even the China data seems to be not very so strong that it can have a sweet spot for EMs?
Well, I think the Fed now is quite uncertain about the prospects for the global economy. It's interesting to note that, heretofore the Fed has been focusing on what's happening in the U.S. only. Now they're beginning to realize that they cannot act in isolation. They've got to see what's happening globally. And as far as U.S. growth is concerned, the latest report we've seen by some of the Fed Reserve governors is about 2% growth, 2.5% growth, which is not really impressive for the U.S. They would prefer to see 3% growth. And of course, their target is 2% inflation. Of course, when that's hit, then they'd be a little happier. But it's really a big question mark as to what's happening with inflation. Because with the internet, you're seeing productivity increases, which are difficult to measure, but are they having an impact on inflation?
Sure. The other big worry for most global investors and GEM investors is what happens to China. The data seems to be stabilizing a bit, but again, the house seems to be divided as to, we don't know as to what China's growth would be, what numbers they'll throw up. What's your assessment on China right now?
That's an interesting point when you mentioned what numbers they throw up, because a lot of people question, are these numbers real? And my feeling is this: China is a planned economy. It's quite unlike India. Of course, India has their budget and so forth and so on, but each state in India has their own way of doing things, and it's a much freer economy. In China, much more planned. So when the Communist Party in Beijing says, look, we're going to have 7% growth, the orders go out to all the governors of the provinces. Say, look, you're going to get 10, you're going to get 7, you're going to get 8, and you better do that. Otherwise, you're not going to get an increase in your pay grade, or you're going to get not going to go up to the Beijing party to get a higher post. So what do? They go out and build. They build a road, they build a bridge, they build an entertainment complex, or whatever has to be done to get that growth. Now, of course, that means wastage, corruption in some degree, but they do achieve the growth rate. So that's why a lot of commentators say, how come they said they're going to get 7%, and that's exactly what they got? They must be fixing the numbers. Yeah, they are fixing the numbers in the sense that they're targeting that degree of growth, and they are going to achieve it. But it's very interesting to note, recently they've downgraded their growth prospects. They said maybe we're not targeting, we should not be targeting such a high rate. We should be maybe going to 6.5. And I think that's makes a lot of sense.
But you see there is a risk to a downside to that target, and maybe you think it can go to even 3% or less than 3%. Is that a risk for China?
I don't see that, because there's still a lot to be done. I mean, if you travel in the cities in China, of course, a high-speed train has been terrific, connecting many, many cities. But then if you go in the cities themselves, you'll see subways have to be built. There's a lot of traffic problems in China. Pollution. Pollution control. Lots of work to be done. So there's no shortage of infrastructure projects. The problem now is getting them through the approval process, because with the anti-corruption drive, officials are afraid to sign anything because they're afraid that they may make a mistake. So that's a hurdle they have to overcome, which is probably why they've been downgrading their growth prospects to 6.5%.
So at 6.5%, do you think the commodities have bottomed out, or do you think there is still a scare coming out of China for the commodity markets?
I think commodities have begun to bottom out. And the reason why is if you look at the projects in the pipeline, I mean, when commodities were flying high, all the major mining companies were engaged in multi-billion-dollar projects planning. Now, most of those have been canceled. So in terms of supply going forward, you're going to see a much, much lower level. That's number one. And number two, a lot of the prices have gone far beyond what is economically viable. For example, copper now, at these prices, a new project does not make sense. So they're not going to move to expand in any direction unless they're halfway through an expansion program. It doesn't make sense for them to cancel. So a lot of the borderline projects have been canceled or will be canceled, and that means going forward prices will stabilize and then begin to creep up again.
So will this be a good time to look at Indian metal companies? Because, you know, a lot of the stocks have corrected so sharply, while they have rebounded off late, but still they are at very cheap valuations. Is this a time to now look at Indian metal stocks? Oh,
definitely. There's no question. There are a lot of commodity stocks that should be looked at. Those with, of course, low cash costs, with very good reserves that are easily accessed, that makes a lot of sense.
So broadly, I know you've been bullish on emerging market equities, you've been bullish on India as well. Right now, at these levels of Nifty in the markets, what's your view? How much can India outperform, at least in the next 12 to 18 months?
I think you can see 20-30% outperformance in India, because there are a lot of things going on that are quite interesting. If you look at exports from India, for example, of not only the hard goods like oil products, that sort of thing, but software exports have been booming. So I think there's a very good chance of outperformance of that level. The other thing to remember is that if Modi is able to get these reforms, particularly tax reform, in place, that would be a big boon for the economy.
Sure. So are you looking for GST very closely? You hope they can pass this at least in the next couple of months, or maybe end of this year, the GST bill?
I hope so. I mean, that's very, very important. I think it's possible that they can do it. They just have to keep on hammering away to get it done. Once that's done, you probably can add another 1% to the GDP.
Sure. But will this lead to a lot of inflows into Indian markets? Because I believe a lot of global investors are looking out for such reforms like GST and the bankruptcy code very closely. So you think that will lead to a gush of money coming back into India?
Oh, definitely. There's no question about it. But just remember, globally, people are looking for yield.
Sure.
I mean, U.S. Treasuries are not paying anything. We're in negative territory in parts of Europe. So people need emerging markets to get the yield and the returns they require.